Established on 9 July 1991 by Tan Sri Dr. Lim Wee Chai, Top Glove became the world's largest natural rubber glove maker, exporting to over 195 countries. This company has been producing latex and nitrile gloves for medical professionals and manufacturers and consumers, and expanded its product line to include non-glove items such as face masks, dental dams, and household items. Top Glove was also elected to the Forbes Global 2000 list in 2021, making it to the only Malaysian glove manufacturer on the prestigious list. Hartalega Holdings Berhad is a Malaysia-based investment holding company that manufactures and sells latex gloves. Harta, founded by Kwan Kam Hoon in 1988, grew significantly in the mid-20s and successfully follows their competitors. Top Glove began to switch from latex to nitrile gloves. Harta has become the world's largest nitrile glove maker with a production capacity of 34 billion gloves per year, with plans to rise to 44.7 billion gloves by 2020. Among the most recent awards earned by Harta includes Gold in Expert Excellence, Exporter of the Year, and the Edge Billion Ringgit Corporate Awards.
To understand Top Glove's position relative to other companies in the industry, we conduct an industry analysis through the use of SWOT. For the strengths, we have noticed that Top Glove have a strong structure and reputation in the industry. Over the years, the company has won numerous awards. They also have been engaging in activities that benefit the societies. By constantly contributing to the societies and corporate social responsibility, the positive image of the company is maintained, and they also would receive the respect from the public. Besides that, Top Glove is also a company that is innovative, in which enables them to provide a comprehensive product range to the public. By being innovative, the company are able to fulfill the demand in both healthcare and non-healthcare segment. By offering various types of product with good quality, the people will give support to the Top Glove, and as a result, the turnover of the company increased and the profitability improved. Despite of having strengths, Top Glove also have some weaknesses, which includes lack of care for employees' welfare. In December 2018, the company has involved in labor controversies where it is reported that the Top Glove's migrant workers were allegedly subjected to forced labor, forced overtime, and more. When the employees work for a long period of time in a day, they might feel tired, and as a result, they perform badly during the working hours. There would be more defect products as compared to before, when the employees can't do their job efficiently. Moreover, Top Glove have a high maintenance cost on the machineries used by them, in which causes the amount of administrative and general expenses of the company increases from year to year. Top Glove use modern technology in carrying out the production process. The machineries that they bought were extremely expensive, and ultimately, the maintenance of the machineries also would be expensive. It will be pricey for the company to fix any components in the machineries that have been spoiled, as the components are not widely used by other manufacturers.
One of the potential opportunities for Top Glove in the future is the growing demand for gloves both locally and globally. It is because gloves are a necessary item in the medical industry, and demand for them has remained relatively stable despite economic and political uncertainties. As health rules become stricter, MIDF Research believes the group's outlook will be supported by consistent and steady growth in disposable medical glove demand. In return, Top Glove can achieve a good sales volume growth despite a challenging and competitive operating environment for next future years. Furthermore, there is also opportunity that the company can grab, which is expanding more of the business in other foreign countries. Currently, there are 20 factories, in which 14 of them located in Malaysia, 4 factories in Thailand, 1 in China, and 1 in Vietnam. Top Glove might want to consider expansion of its business in Indonesia, a tropical country next to Malaysia. Its tropical climates enable the growth of rubber trees, which used to make latex, ease glove production through massive supply of latex delivered to Top Glove. Besides, Indonesia also a country with one of the world's lowest labor costs. The combination of cheap labor costs and massive supply of raw materials would be a good region for Top Glove to expand in and allows the company to sell glove at lower price to compete effectively in global market. Increase in raw material price is one of the threats faced that could hinder growth for Top Glove. As the demand gets higher in manufacturing the rubber latex gloves, the price of latex also being pressured. Top Glove need to bear the volatility of the rubber price, especially when it is increased that will affect its earnings. Perhaps Top Glove could consider of rapid expansion of production capacity that may lower this pricing pressure issue. Increase in raw material price is one of the threats faced that could hinder growth. In addition, intense competition in the market for rubber glove manufacture could be one of the threats. Top Glove competes in the glove sector against a number of large local competitors including Hartalega, Kosan, Rubber, and Supermax, all of which are among the top gainers on the local stock exchange. Several global competitors including Kimberly-Clark US, Ansell Limited Australia, Allfund Enterprise China, and others. Some of these manufacturers are focused on boosting capacity, providing gloves at cheaper pricing. It is difficult for business to secure orders in this challenging market, especially given the high level of competition both locally and globally.
Now we will move on to the vertical common size analysis of both Top Glove and Hartalega. For this project, we have dividing each item with the number of sales generated. If we refer to the table, it shows that the gross profit of Top Glove has fluctuated over the past 3 years, where there is an increase from 17.76% in 2017 to 20.9% in 2018, then drops to 18.41% in 2019. This is due to the amount of cost of sales increase in line with the revenue, which affect the percentage of gross profit to fluctuate significantly. As compared to Hartalega, the percentage of gross profit is declining significantly from 26.93% in 2017 to 25.5% in 2019. This is due to the increase of cost of sales. Although Hartalega's gross profit is declining, they are still better than Top Glove as their percentage of gross profit is much higher. Next, the percentage of Top Glove's other income has dropped significantly from 1.57% in 2017 to 0.8% at the end of 2019. This is because there is a crucial fall in realized gain on foreign exchange throughout the past 3 years from 26 million ringgit to 0 ringgit. Top Glove also has claimed insurance in 2018 by 4,996 ringgit and 2019 only by 899,000 ringgit. In contrast, Hartalega's percentage of other income has fluctuated, where in 2017 there is 0.76% of other income over the revenue, 2.62% in 2018 and 0.48% in 2019. The details of other income have not been disclosed in the notes of financial statements. Therefore, we conclude that the drops in Top Glove's other incomes is acceptable since the gap between the year is closer than Hartalega. The fluctuations of Top Glove's total expenses was due to the change of administrative expenses that is more significant compared to distribution expenses, while for Hartalega, the total expenses shrunk from 8.48% in 2017 to 5.67% in 2019. As most of the expenses incurred over the years have also decreased. This indicates the improvement in managing the expenses as compared to Top Glove. Increasing finance costs for both companies will mean that they have taken additional credit facilities, and the purpose of such financing should be analysed. Hence, we considered Hartalega to perform better in managing the finance costs as the percentage of their finance cost is lower than Top Glove. Hence, despite the fact that both Top Glove and Hartalega's percentage of profit after tax has fluctuated over the last 3 years, the company's performance is still stable as they manage to make profit every year.
In terms of non-current assets, the instability of percentage was insignificant for Top Glove and Hartalega's PPE, as it was due to the annual depreciation charge, acquisition and disposal of the fixed assets. Top Glove acquisition of intangible asset in year 2019 result in an increase in intangible assets amounting 22.09% of total assets, while for Hartalega, they had written off their intangible asset in 2018, which result in a decreasing percentage by 0.1% and remain constant in 2019. In conclusion, Top Glove is in a better condition as they are able to acquire more non-current assets over the past 3 years. However, Hartalega also has an increase but in a smaller percentage compared to Top Glove. There is a significant increase for inventories of Top Glove, in which the inventory increased to 11.07% in 2019 and contribute the most of the total current assets. It indicates that higher inventories are being held by the company in 2019 compared to other years. The decreasing trend of Hartalega's inventory percentage from 11.83% in 2017 to 9.21% in 2019 indicates that the company is efficient in turning their inventory into sales. This can be proved by the increasing trend of inventory turnover for the past 3 years. While doing this analysis, we found that the current assets of both companies are largely held by the trade and other receivable. However, Top Glove trade and other receivable shows a declining trend throughout the years with 14.28% in 2017 to 10.41% in 2019, which shows that there is a decrease in credit sales. Hartalega, on the other hand, had a fluctuate trend. This indicates that the company is inefficient in collecting the trade and other receivable from their customers. As for the cash, bank balance and short-term investment of Top Glove, they show a significant drop from 15.22% in 2017 to 4.45% in 2019. This is because for the past 3 years, the company has purchased more non-current assets, while for Hartalega, it's more or less the same from 2017 to 2019. To conclude, Hartalega has a much higher percentage of highly liquid asset in terms of cash, bank balance and short-term investment compared to Top Glove. Top Glove can be seen to have an increasing percentage of short-term loan and borrowing, with 10.72% in 2017 to 18.31% in 2019. This demonstrates that the company has an aggressive growth strategy being funded by debt, as their loan and borrowing increased significantly over the past 3 years. Hartalega, on the other hand, shows a fluctuate trend where it is increased from 6.45% in 2017 to 7.38% in 2018, then dropped to 4.97% in 2019. This is because Hartalega started becoming less dependent on debt to grow their business in 2019, which proved that Hartalega has performed better compared to Top Glove, who continuously acquire loan to help with their financial issues. Furthermore, Top Glove share capital has been decreasing over the years from 21.68% in 2017 to 13.86% in 2019 due to the decision made by the company to be funded by debt more than the equity. This also can be seen as the total debt of the company increased over the year. Due to the issuance of bonus issues, Hartalega percentage jumped from 36.31% to 49.86% in 2018, but then declined to 46.82% in 2019 when no more bonus issues were issued. Therefore, it shows that Hartalega has a high equity financing portion compared to Top Glove. Sales in receivables measures the number of days taken on average for a company to collect its receivables. For Top Glove, day sales in receivables increased from 42 days to 55 days in year 2017 to 2018 and decreased to 43 days in 2019. Whereas for Hartalega, day sales in receivable is more or less the same from 51 days in 2017, 49 days in 2018 and 52 days in 2019. Increasing trend indicates that the company are taking more time to collect its receivable and vice versa. However, it does not indicate the efficiency of the company's receivable collection time due to the fact that it must be compared to the terms of the company's credit. Both companies have generally trade credit terms range from 30 to 90 days, which they do not appear to have a collection difficulty since the days in receivables are not considerably longer than the credit term. This could possibly be because of payment discipline among buyers has strengthened.
The account receivable turnover determines how many times a company can convert its receivable into cash in a given time frame. A high ratio implies that the company is excellent in recovering debt from the debtor. However, based on our analysis, Top Glove has shown a decreasing trend, which is from 9.45 times in 2017 to 8.4 times in 2019. This shows that Top Glove is inefficient in collecting their receivables, and the proportions of quality customers that pay their debts quickly decrease. Whereas for Hartalega, there is a fluctuations of account receivable turnover from 7.92 times in 2017 to 8.31 times in 2018 and finally decreased to 7.78 times in 2019. This indicates that Hartalega's customers is experiencing cash flow problem for a certain year, which make them unable to pay their debt quickly. As a whole, we can conclude that Top Glove has performed better in collecting their receivables as compared to Hartalega for the past 3 years, as they have acquired higher turnover despite of decreasing trend in the ratio.
Days sales in inventory measures the average number of days or time it takes for a company's inventory to be converted into sales. Based on our analysis, days sales in inventory of Top Glove increases from 41 days in 2017 to 59 days in 2019, whereas for Hartalega, days sales in inventory decreases from 74 days in 2017 to 47 days in 2019. This shows that Hartalega is faster in selling its inventory to the customer. The results of being able to sell the inventory more quickly is that Hartalega would receive a rapid turnover, leading to higher profit. This shows that Hartalega is more efficient both in terms of sales performance and inventory management.
The inventory turnover ratio measures the cost of products sold with average inventory over a period of time to determine how effectively inventory is managed. According to the analysis, Top Glove inventory turnover has decreased over the last 3 years from 9.68 times in 2017 to 6.88 times in 2019. This indicates that the inventory are held for a longer period of time than previously measured time period. Hartalega, on the other hand, has seen an increase in inventory turnover from 5.64 times in 2017 to 7.48 times in 2019. This shows that the inventory are effectively sold or replaced over the time. Hence, Hartalega's inventory management is better than Top Glove. Fixed assets turnover measures the ability of a company's fixed asset investment to earn net sales. Based on the annual report, Top Glove's ratio decreased from 2.27 times to 1.23 times from 2017 to 2019. However, Hartalega has the opposite trend, increases from 1.21 to 1.46 in 2017 to 2019. It shows Hartalega made use of its fixed asset investment effectively in generating sales as compared to Top Glove that shows decreasing trend with quite a huge gap from 2017 to 2019. Both companies maintain a good fixed asset turnover ratio, which is above 1, since they are the manufacturing companies that heavily use their fixed asset in making sales compared to other industry such as internet or retail company.
Current ratio is a measure of a company capacity to satisfy short-term obligations, in which can be calculated by dividing current assets with the current liabilities. Based on the annual report, current ratio for Top Glove decreased from 1.57 times in 2017 to 0.97 times in 2019. As for Hartalega, the current ratio increased from 1.91 times in 2017 to 2.18 times in 2019. Top Glove decreasing trend is due to significant increase in inventory as it difficult to sell and have longer time to convert into cash. Thus, Top Glove may have difficulties in meeting its short-term obligations in due time, while Hartalega shows increasing trend because of significant decrease in inventory as the cash sales generated increase. This enables Hartalega to meet short-term obligations with the available cash obtained. Since the minimum acceptable ratio is 2 times, it shows that Hartalega has better liquidity positions compared to the Top Glove. Quick ratio indicates the company's capacity to pay its current liabilities without needing to sell its inventory or to obtain additional financing. For the 3 years period, the quick ratio of Top Glove fell from 1.18 times in 2017 to 0.57 times in 2019. This shows that the company may not be able to fully pay off their current liabilities in the short term. In contrast, for Hartalega, their quick ratio has shown an increasing trend for the past 3 years period, from 1.16 times in 2017 to 1.51 times in 2019. A company that results higher than one can manage to instantly get rid of their current liabilities. Thus, we can clearly see that Hartalega has shown way better performance as compared to Top Glove, as they can settle all of their short-term obligations easily.
Cash ratio measures the ability of the company to pay off their short-term debt obligations with only cash equivalents and marketable securities. Based on our analysis, cash ratio for Top Glove decreases from 0.56 times in 2017 to 0.16 times in 2019. As for Hartalega, they have the opposite trend, where their cash ratio increases from 0.33 times in 2017 to 0.38 times in 2018, and finally relatively constant to 0.37 times in 2019. Having a cash ratio below than 1 times means that both companies might have difficulties in paying their short-term debt obligations. However, the cash ratio does not necessarily provide a good financial analysis. Referring to the statement of financial position of Top Glove and Hartalega, both companies have a higher amount of non-current assets as compared to their current assets. This shows that they are utilizing their cash by buying more non-current assets to be used in the production process. Debt ratio is a measurement of how much of a company's assets are financed by debt. Based on our analysis, Top Glove's debt ratio increases from 31.46% in 2017 to 55.1% in 2019. As for Hartalega, its debt ratio decreases from 26.32% in 2017 to 24.11% in 2018 and slightly increased to 24.49% in 2019. To compare between both companies, Top Glove shows increasing trend from year to year compared to Hartalega that is relatively constant. It shows that most of the Top Glove's asset is financed by debt and has a higher chance to have a problem in meeting its long-term debt compared to Hartalega.
The debt-to-equity ratio is a leverage ratio that compares a company's total debt to total equity. Throughout the year, Top Glove debt-to-equity ratio shows an increasing trend with 0.46 in 2017 to 1.23 in 2019. It shows that Top Glove have an aggressive growth strategy being funded by debt as total liability increased significantly over the past 3 years compared to their shareholders' equity. Hartalega, on the other hand, shows a decreasing trend with 0.36 in 2017 to 0.32 in 2018 and remain constant in 2019. This indicates that Hartalega used more equity in financing their operation than debt. Therefore, Hartalega is seen to be more financially stable compared to Top Glove as its debt-to-equity ratio is lower. Times interest earned ratio indicates how much times a company could cover its interest expense using the pre-tax earnings. High ratio means better earnings are available to meet interest payments. Both companies' ratio shows a positive decreasing trend. Top Glove's ratio decreases significantly from 6.68 times to 6.32 times in 2017 to 2019. As for Hartalega, the ratio also decreases significantly from 343.73 times to 52.87 times in 2017 to 2019. The decreasing trend for both companies attributable to an increase in interest expense as a result of increased debt over time. However, since both companies' ratio are both above the minimum acceptable amount, which is 2, it indicates that they are still able to fully pay its interest obligations. The net profit margin is a percentage of revenue that measures how much profit is earned. Net profit margin of Top Glove increased from 9.7%
10.63% in 2017 to 10.39% in 2018, and decreases to 7.66% in 2017. While for Hartalega, its net profit margin increased from 15.55% in 2017 to 18.28% in 2018 and decreased to 16.09% in 2019. As we can see, both companies shows fluctuate trend from years to years. It shows that an average Hartalega has higher net profit margin compared to Top Glove, in which indicates that they are more efficient in managing its expenses relative to its net sales.
Return on asset measure how efficiently a company can squeeze profit from its asset regardless of the size. A positive ratio indicates that the company is efficiently utilizing its asset to generate profit and vice versa. Top Glove ROA has declined from 11.76% in 2017 to 6.71% in 2019. This falling ratio indicates that Top Glove might have overinvested in assets that have failed to produce revenue growth, or as a sign that the company may be in trouble. Although the sales of the company increased over the 3 years period, the ratio are in downtrend as the number of assets increased more than its profit generated. While for Hartalega, the ratio have been fluctuated over the years, which was 13.34% in 2017, rise to 17.88% in 2018, and slightly reduced to 16.80% in 2019. The decreasing trend is due to the increasing of total assets for the ongoing commissions of Plan 5 constructions. Thus, in average, Hartalega has performed better as compared to Top Glove as the ROA is much higher.
Return on equity measures the effectiveness of a company in using their equity to generate income. Based on our analysis, return on equity of Top Glove increases from 17.11% in 2017 to 19.88% in 2018, then decreased to 14.86% in 2019. As for Hartalega, the return on equity increases from 17.77% in 2017 to 23.88% in 2018, then decreased to 21.38% in 2019. To compare between both companies, both shows a fluctuating trend from year to year. However, in average, the return on equity of Hartalega is higher as compared to Top Glove, in which indicates that Hartalega is more efficient in using their equity to generate income.
The total asset turnover ratio determines how effectively a company uses its assets to generate sales. Top Glove total asset turnover ratio has decreased from 1.22 times in 2017 to 0.88 times in 2019. This is due to a significant growth in their total assets beginning in 2018. In contrast, Hartalega total asset turnover has increased from 0.86 times in 2017 to 1.01 times in 2019. The increasing value indicates that Hartalega is effectively utilizing its assets to generate sales as its total assets increase parallel with sales. Although both companies have a good ratio, Hartalega has a better ratio than Top Glove since their total assets turnover ratio is improving.
Gross profit margin ratio assesses a company's ability to produce sellable items at an effective cost. High ratio indicates the company managed its cost of sales well. As per annual report, Top Glove's ratio increased from 17.76% to 20.09% in 2017-2018 and decreased to 18.41% in 2019. The decreased ratio in 2019 was due to climate change that impacts raw material supplies, hence increase in raw material costs, while Hartalega's ratio shows decreasing trend from 26.93% to 25.05% in 2007-2019 due to increase in cost of sales caused by increased prices of raw materials. If we compare both companies, Hartalega shows a better cost-effective manner as its ratio throughout the years are above 25%, higher than Top Glove's. Generally, both companies' gross profit margin ratios considered to be healthy.
For the short-term future prospect, Top Glove Corporation Berhad and Hartalega Holdings Berhad will have a better performance in the year 2020 and 2021. We anticipate an increase in demand for healthcare products as a result of the COVID-19 pandemic that has begun to spread in China on November 2019. Since both of these companies are directly involved in supplying gloves, hence this outbreak will affect them with rising stock prices. The medical gloves market is expected to expand as the demand for gloves to prevent germ transmission grows. When the gloves demand increases, the sales and profit of both companies also will improve. As a result, both companies will have a better financial performance where their earnings per share increases, hence able to provide more dividends to their shareholders. In the perspective of investors, it is advisable for them to invest in these companies as the return on equity also will increase.